Welcome back, everybody, to another webinar organized by Princeton for everyone worldwide. We're very happy to have Werning with us today. Hi, Ivan.
Hello.
Great to have you with us, and with you, your co-author, Emmanuel Fari, who we're honored to have with us today spiritually. And he's a genius, and he was a genius, and he will be careful and inspire us for many, many decades to come. Ivan will talk about this joint work with Emmanuel on taming a Minsky bicycle. And before I give the floor to Ivan, I would like to mention some points about Minsky to introduce Minsky to some extent. So of course, Ivan will talk about extrapolative expectations. That's essentially adaptive expectations in the change, in the growth. And Janoli Schleifer have written recently a book covering this topic as well. And extrapolative expectations lead to momentum and to bubbles. And I would like to spend some time a little bit on bubbles, where you have this exploding path, essentially. Once things get going, they get faster and faster, while the fundamental might stay fixed and it's not changing. So what are bubbles? They're good bubbles and bad bubbles. And for example, when you have new technologies, be it the railroads or be it the internet or something, you need huge R&D investments. And we have seen earlier in the webinar series, there's this double problem of externalities. There's too little R&D investments, and there are also some QWERTY problems, so the chicken and egg problems. Nobody wants to start to do the first investment as long as the other sector is not investing. And bubbles and euphoria can help to overcome these problems we face in the real economy. In this sense, bubbles are good that change and the technology and make us more productive. We also have bubbles which are acting as safe asset. They give us a precautionary savings tool, and the government can issue debt and roll it over if R is smaller than G, like a Ponzi scheme. And I think we have to rethink our asset pricing. It's not just asset pricing, not just the expected present value of cash flows, but also the expected present value of service flows. And the beta, the CAPM beta of the cash flows might be negative, but of the service flows, it might be positive. For example, if you have a model with idiosyncratic risk, where idiosyncratic risk goes up in times of crisis, then the service flow becomes more available. So the service flow is actually a negative beta, and that might dominate the whole asset price, and hence it becomes a safe asset after all. And that's also a good bubble to have, because it allows us to reinsure idiosyncratic risks through retrading, because whenever you face a shock, you can sell your safe asset to me, who hasn't faced an idiosyncratic shock at this moment. Of course, we have other bubbles as well, like the real estate bubbles, which leads to increased prices, but not enhanced efficiency or better risk sharing. And then we have bubbles which are driven primarily by financial innovation, like the housing bubble or real estate bubble 2006, where had all this financial structuring going on, or financial liberalizations, which led to bubbles like in Scandinavia in the 90s and so forth. And then most recently, we have Bitcoin, which has essentially no cash flow coming at all. And it's questioned whether there's some service flow, and it's exploding in value tremendously. All of these are bubbles, and they're driven to some extent by extrapolative expectations. We try to learn more, and there are some bubbles which are more dangerous than other bubbles. So there can be harmless bubbles and dangerous bubbles, and it depends very much how they're financed. And they can be either equity financed, like the internet bubble. Everybody was just buying these underlying stocks without getting levered and without taking on margins, or you can do and get credit financing of these bubbles, and then they become way more dangerous. So the bursting of these bubbles becomes much more severe. And what Ivan will present today is actually asset purchasing on a levered basis, where you borrow in order to buy more assets. Minsky did this, of course, too. He actually classified this borrowing as hedge borrowing. You borrow as long as you can pay off the debt and the principal, the interest and the principal every period, then it's hedge borrowing. You call it speculative borrowing if you can only pay off the interest, and you call it a Ponzi scheme if you have to roll over the debt, because in order to really pay back the interest you promised as well. And that's, in the safe asset perspective, you can have a Ponzi scheme if R is smaller than G. But that's what Minsky distinguished between these three classifications. So the question I would like to weave in the poll questions: should policymakers really fight bubbles? It depends probably what type of bubble it is, whether it's a harmless or dangerous bubble, whether it's a productive bubble leading to new technology or not. So it's a quite open question, but how should we fight it? Should we lean against these bubbles up front, or should we clean afterwards? And there was this big debate between leaning and cleaning, essentially. And the poll question is that you should lean before as well. It was about 80%, and cleaning up afterwards is only 20%. And then the question is, what tool should you use to do this? And I think Ivan will allude to that as well. The poll questions were monetary policy tools, primarily, only 5% think this way. Primarily macro-potential tools, 40%, and using both, that's what 55% think. And I'm curious to see what people will say after Ivan's talk, whether they have a different opinion afterwards, but it's a hotly debated topic. We would like to understand better from that. So let me come back to Minsky again. So Minsky, when he talked about bubbles, he distinguished between 5 phases of a bubble, or stages of bubble: the displacement phase, the boom phase, the euphoria phase, and profit-taking and panic phases. And typically the way bubbles work is that initially there's some fundamental innovation, could be financial innovation, could be railroads, could be the internet, or could be some new innovation. Bitcoin might be an innovation. There's fundamental improvement, but at some point the fundamental stops growing and stays, let's say, flat. But because of extrapolative expectations, some irrational investors push up the price further and further. And that's essentially when the bubble starts. But of course, we don't know exactly when the bubble starts, and people might differ in their prediction when the bubble starts. And the big question is, how can it be that the price goes up? Why are the rational guys, the rational investors, not bursting any bubble? And wouldn't we expect this if you think of backwards induction arguments and other arguments that that's the case? And that's, you know, the big question: why do rational investors ride rather than attack the bubble? And that's because they face a competition among themselves. So there's an element of competition and there's an element of cooperation. There's a competition. Let's say only 30% get out of the bubble early enough. So it takes a critical mass of people to break the bubble, to burst the bubble. So they compete to be among the first 30%. But there's also an element of cooperation. You want to ride as long as possible until the Mr. 30 is getting out of the bubble, essentially. And this leads to a persistence of the bubble and a riding phenomenon of the bubble if the information, you know, is not commonly shared when the bubble starts. And it could be that they become sequentially aware. So the first guy becomes aware, and the second guy, and each day one trader, let's say, or a mass of traders become aware of this bubble. So that's, you know, in this box, you can see they'll come one after each other. And then after 100 days, all 100 rational investors become aware of the bubble. But you can see it takes 100 days until everybody knows that there's a bubble. And then, but at that point, not everybody knows that there's a bubble. Everybody knows, but not everybody knows that everybody knows. Okay. So you have to wait another 100 days. And then after another 100 days, everybody knows that everybody knows that everybody knows that there's a bubble. And hence, it takes always 100 days. You get one layer of higher mutual knowledge, but it comes never common knowledge, but common knowledge means everybody knows that everybody knows that everybody knows infinitely often. And that's what you need in order to do some backwards induction. That kills the backwards induction argument, because you need a commonly known point from which you can start backwards induction, and in order to kill bubbles right away. And that allows bubbles to persist, and the irrational investors hence find it more profitable to ride the bubble for a while and then only attack later on, and then the bubble actually persists for a while and only bursts later on in the final stages in the panic phase. So with this little overview of, you know, Minsky's thoughts and my thoughts, this is based on earlier work I did with Dilip, I will just mention the final poll questions. So the first two we covered already. The last one was, so when you have this people investing with extrapolative beliefs, so they have distorted beliefs and they're exuberant. Of course, when we regulate this, we have to assume how exuberant are the policymakers. And the question was, do you think policymakers, this belief distortion exuberance, are smaller than the markets, the same, or larger? And people think, you know, that policymakers are more rational than the markets. 40% think this way, that they're the same. That's another 40%. And actually 20% think it even more irrational than many market participants. So with that, I pass on the floor to Ivan, who will talk about taming a Minsky cycle once it, how to control it, and we will be excited to hear his take on that. Thanks again, Ivan, for being with us. Looking forward to your presentation.
Thank you so much, Markus, for inviting me and for that introduction. Yes, this is a joint paper with Emmanuel Farhi, who I think about every day. And this is a paper we have been presenting for a couple of years, but still working on. This last summer, he presented at the MBR, and we're sort of put it out a little bit into the wild, the paper, but I expect to have a real public version in the coming weeks. And it used to go under a different title. So this is Taming a Minsky Cycle now. Let me tell you where we're coming from and what we do that's new here. So we've been very interested and excited about thinking about macroprudential policy. And let me make sure, yeah, there we go. And when when one thinks about macroprudential policy, really at the intersection of macro and finance, there is a couple of different motivations that you hear. Perhaps the most common one is just this idea, maybe more micro motivation based on financial fragility, all right? An idea that we've been pushing is that, it also feeds back into Main Street, and it's through aggregate demand externalities and interacts with stabilization policy. And that's an idea we've been pushing in a couple of papers. And that's tied to the idea that monetary policy has constraints or faces dilemmas. So we've worked on this in the context of capital controls and in an open economy, and then turned to more closed economies. And in this prior work, we've done these open economy and closed economy, thinking about a deleveraging episode. And the work there really has demand externalities, but also pecuniary externalities, which are perhaps also common in the literature. And the main result that we got there was, a formula that ties up the shadow distortions you want to introduce in financial transactions, linked, so that if you want the shadow taxes we impose on Wall Street, taking into account the distortions we expect are going to be present on Main Street. So that's kind of the bottom line result we got. And we've been sort of applying it in different settings. What's new today, I'm going to be talking about some ideas that are in Minsky boom-bust cycles. So I'll come back to Minsky in a moment, but basically we're trying to capture the idea that there's a period of a boom with rising asset prices and leverage, followed by what people call a Minsky moment, where risk is repriced, asset prices fall, and there's deleveraging. And in our economy, this is going to, hurt the real economy as well. All right. And if you read Minsky, describes a little bit like Markus was talking about the different phases of the boom. We are going to try and capture that by importing work that's been done in finance, documenting extrapolative expectations. So we're kind of jumping into this wilderness of non-rational expectations. And that's, if you want to think about it, what's really different from the past work that we've done. Okay. So we didn't come at this after reading Minsky and saying we want to write. We came at it thinking about this framework that we had. We think it's important to think about macroprudential policy with good foundations, for theoretical foundations, and we had constructed that. But we always felt a little guilty that when thinking about finance, we should pay attention to the kind of booms that are often explained more easily by thinking about these kind of deviations from rational expectations. All right. This is kind of a schematic of how we think about macroprudential policy that will have a parallel in our paper. but this is more general in our paper. So the way when I think about macroprudential policies, there's some financial decisions that are taking place. And you can think of this during the boom period. Okay, so borrowing and lending, risk taking, etc. And after that, there's a period where there's going to be the bust, maybe triggered by a shock or a small shock, or not. But the main thing is that the outcome here is affected by the decisions that were made here. Okay, so we might always end up with a recession here, but the size of the recession could be much worse depending on the financial decisions, right? Or in fact, whether we get a recession at all might depend on those financial decisions, all right? And so there's kind of a sequence of things one can ask is, okay, so the basic idea of macroprudential policies, since these decisions have an impact here, we need to regulate them. And the basic point is, wait a minute, not so fast. We have to always ask if there's a market failure, all right? And maybe we have strong priors, there's some market failure, but we have to pinpoint and think harder about what that market failure is, right? And, we're going to use the language of there's some externality that we have to think about. And Markus already said this, an alternative also for macroprudential policy. So when we think about macroprudential policy, we should be thinking about monetary policy as another option. So one idea is you could clean up after the fact here with monetary policy or maybe fiscal policy. And well, our answer to that is, I think in present day, not controversial, that monetary policy is pretty constrained, either in the US by the zero lower bound or in Europe by the zero lower bound, and having a common currency across countries experiencing different situations. So another idea is to shift the focus. Okay, what can we do with monetary policy during the boom? Okay, so these are, I think, any framework should have these three options and think harder about what the externalities are, right? Okay, so in our framework, the externality, the main one we want to focus on is aggregate demand externalities. In this period, the recession is going to be worse the higher is leverage in the economy, for example. Okay, so then that will be an externality of a Keynesian aggregate demand sort, and will lead to justify these considerations of macroprudential regulation. Just briefly, before I jump into what's new, mentioning quickly, what we had in this previous framework that we developed is quite a general formula, as I said earlier, trying to tell you what the interventions are as measured by the shadow tax you impose on financial transactions, which is this, as a function of the distortions you expect exposed in spot markets, in good and labor markets. So think of, how bad the recession is. That's going to create wedges, we call them, sort of shadow taxes. And a recession looks as if you have discouraged labor and there's a wedge there, interacted with the marginal propensities to consume that different agents have in these states of the world and for these different markets. Okay, so this is a formula we've leveraged before, and the model is quite general. And in some sense, what I'm doing now is starting from that, but including these expectational departures. Okay, so what is extrapolative expectations? Markus mentioned the book by Gennaioli and Schleifer that I highly recommend. This is an article by Greenwood and Schleifer that documented that the survey of investor expectations about future returns, okay, they move across many surveys and they correlate with past returns, okay? So here you have both that survey on one axis and on the other axis, the past 12 months of the S&P 500, okay? So this is the kind of evidence, and there's a lot more, this is just a teaser, the kind of evidence that have led some people to think we have to take the idea of extrapolative expectations seriously. Okay, so the elements I'll bring in that are new is that extrapolative expectation. And the kind of questions I'm going to ask is, as Markus framed them, what should we do about these situations, both in terms of macroprudential policy and monetary policy? And I want to frame our model will also capture the idea that there are really two targets, two goals: a macroeconomic goal in the present, where the recession is now, and a sort of financial stability goal, which is going to impact where, the recession in the future. So these are the two goals. And one way to think about this roughly is that, the Tinbergen target and instruments idea. So you're going to trade off these targets, these goals, with the instruments you have. And some of our results will be of the sort of, okay, for these goals, use these instruments, and a kind of mapping between, or assignment between the targets and the instruments of macroprudential policy and monetary policy, which I think is useful way of thinking about it. Okay, but a key role for us will be this endogeneity of beliefs. All right.
So you also go into welfare analysis, or you focus on macroeconomic financial stability goals, or do you do overall welfare analysis as well?
No, exactly. Great question. I should have said it. I take it as given. All our work is very influenced by constructing simple models, but for which we can carry out a welfare analysis. So, for example, this formula is the optimal macroprudential intervention. And likewise, today we'll be talking about the optimum interventions. Okay, so we came at these questions having worked also a lot on optimal taxation and public finance, and kind of merging that approach with a more macro approach. So we're definitely in the camp of thinking about the insights that we can get by formulating the welfare analysis.
And the social planner has rational expectations.
Great question. Yeah, I was going to come back. We did both cases, so it's a good question. If agents have beliefs that maybe are wrong, should we evaluate their utility using those beliefs, or should we, evaluate their utility using the objective belief, so to speak? And we did both, got similar results. For the analysis today, I'll talk about the case where we evaluate with objective beliefs. Otherwise, there are some funny extra terms that have an interpretation of you doing things so that people are happy thinking about what's going to happen, and even though it doesn't happen. And we think that's not necessarily the more defendable, realistic case that people have in mind. But great questions. I should say that we wrote this paper and with a different title, and then read Minsky and thought it was appropriate. That doesn't mean we are. So that's actually to say we're not going to try and capture everything Minsky said. Okay, this is not that kind of paper. But we think we hit some notes that Minsky was jamming on, and just like Keynes, people think, well, Hicks didn't capture everything. We're happy enough capturing some important parts today. All right. And actually, speaking of Minsky, he was very unhappy with the way people had captured Keynes. So the whole idea of Minsky is that Keynes actually thought about financial stability, and this was lost in the sort of Hicks ISLM framework. All right. And that painted too rosy a picture when it came to thinking about stability. All right. So that was his big point. And the main message was that there's the model, the system, the economy is actually endogenously unstable. So it's not just that we're going to be hit by exogenous shocks, but somehow the system is prone to going to the edge of the precipice. And money and fiscal policy are not going to be enough to completely stabilize the economy. All right. And it's actually those moments of tranquility where you do manage to stabilize it that seeds that create the seeds for risk taking and create eventually the boom and bust cycle. Okay. And there's financial market, and the emphasis was that financial markets are very different than the real economy in various ways. We're gonna do this with the rational expectations, but the key thing is it's much more complicated. You have to think about the future, etc. And that's where I think it creates differences, and one important difference especially appears if you have irrational expectations. Here's some quotes I was reading last week, Minsky. Here's some quotes. Again, we're not trying to capture everything Minsky, but that we think the thinking that the speculative boom is affected by beliefs that are endogenous and feedback, and have to do with kind of a extrapolative type idea resonates throughout this book, Stabilizing an Unstable Economy. All right. The idea that a rise in the price might actually make the asset more attractive, that really, is kind of drawing on that idea, I think. All right. And then Minsky was pushing, we really need a theory to think about these issues and to go forward in a normative way. And the normative way included thinking about financial interventions, right? So I think in that broadly, we're capturing some important aspects of that. That's why we included it in the cycle. I'm going to skip the related literature. At this point, I'd like to ask how much more time you think I have, so I make sure I...
About half an hour.
Okay, great. I think we're good. Okay, so I'm going to be filling out this table through the talk by starting with the basic economy and thinking about the rational expectation case and thinking about the situation where we have monetary policy only, or we have monetary policy and macroprudential policy. By IT, I mean inflation targeting here, right? And I'll put some caveats on what I've entered here later. There's some subtleties, but basically we're going to be filling this out, okay? So why would I focus on the column with monetary policy without macroprudential policy? For two reasons. One is I think macroprudential policy is still on the rise in terms of, being implemented and thought through, especially from the angle we're coming at, that it's a concern not just about the stability, the financial stability at a more micro sense, contagion, those kind of things, but also, the bailout, moral hazard problems, but also the effects they have on the real economy, right? The other thing is that macroprudential policy, we have to admit, we're going to model in a very simple way where, like, if you want to control leverage, you can control it. But the reality is there are loopholes. There's always ways to get around it. So one reason for filling out these two columns is that reality might be somewhere in between these two, okay? We're going to be a little loose on that. We're just going to model the case where it's available or fully available or not available at all. But the idea is, that, Jeremy Stein has been a proponent of this, that monetary policy is easier and fills all the cracks, whereas macroprudential policy always leaves, some loopholes open. We think that's a reasonable argument. So that's the one reason for doing this. Okay. Let me jump into our theoretical framework. So again, our goal is to build kind of simple models that have insight, all right? In that sense, they'll be very simple, 3-period type models, and we're gonna make a lot of simplifying assumptions to get at the heart of things in a way that's more clear, we think. And these models could be expanded in future. So, but in spirit, we're very close to he and Krishnamurti, we think, and related to Brunnermeier-Sannikov. And that at the heart, there's going to be a risky asset. There's an asset pricing model, okay, with incomplete markets. But we're going to add to that nominal rigidities and think about optimal policy. So that this bullet would be our contribution, so to speak, right? So the financial backbone is incomplete markets. There's going to be a risky asset, right? And there's going to be risk-free short-term borrowing and saving. And any model of financial markets, to be interesting, has, in macro, has to have more than one agent, and so that there can be trade between them. We're going to have these two agents. We'll call it savers and borrowers. The savers are going to be saving in a risk-free asset. That's it. Maybe it's a constraint, or we could model preference for safety. Okay. And that's very in line with the Krishnamurti framework. The borrowers, they will be borrowing that risk-free asset, but they have the capacity or know-how to invest also in a risky asset, in that Lucas tree I mentioned earlier. Okay. There's going to be 3 periods, 0, 1, and 2. So 0 is the first period. And in each period, there'll be consumption goods and labor. And the key way we're going to introduce an effective monetary policy is nominal rigidities we'll be doing that in an extreme way with nominal wage rigidities, actually assuming they're completely constant. So we're not going to be focusing on inflation here. So this is a schematic of the timeline, and relative to the chart I showed in the intro, this would be the boom phase, and these 2 periods would be the rest. Okay, but here we have 3 periods, and in the first period there's the borrowing and saving and investing in the risky asset, and there is consumption and labor. So there might be a boom or a recession here. We have to ask the question. Here is the bust period, and the important thing is we're going to assume that we can choose parameters for this to be the case, that in the bust period, monetary policy will be exhausted, will hit the zero lower bound. Okay, so there will be a recession here, just to focus attention. Okay, that's our concern, thinking about how big the recession is here. And then the last period is relatively simple. It's kind of a residual. That's where we put the payoff of the risky asset. So this last period, there's no production, there's only consumption, and it's all coming from the Lucas tree, okay? So this is just a device so that there's an asset that you can buy and sell here, you can buy and sell here, and pays out the dividend here, okay? And that's just a way to introduce the asset, all right? Okay, anything else I needed to say? Yeah, and here in these 2 periods, this is where the nominal wage rigidity is going to affect the economy, all right? So we might be in a recession or a boom here, in an inefficient sense, all right?
So Ivan, can you explain also as you go through what happens if you don't have the nominal wage rigidity and no zero lower bound? What would happen in the cleanest, without frictions, only incomplete markets?
Yeah, so in that case, you know, the market is incomplete, so the allocation is not ideal, okay? You would rather share the risks, but you're not able to. But other than that, there's no added inefficiency in the economy. All right. So we're going to focus on measures of inefficiency that go beyond the amount of risk sharing, that have to do with, you know, whether there's too little employment in this period, for example. Okay. But a model without the nominal wage rigidity would not be first best efficient because there's incomplete markets, as you say. But it would not have the kind of inefficiency that we're going to be focusing on. And it would be, in this case, constrained efficient, because there's really nothing to be done about the insurance here, because we've just assumed that, you know, the savers cannot hold this asset.
So there is no other externality in the model. I mean, the aggregate demand externality works through the wage rigidity and the zero lower bound.
Exactly. Yeah. Now we've in our econometrica paper, we have also pecuniary externalities. So that's a case where incomplete market itself can be inefficient, because by distorting the decisions people make in financial markets, you can favorably affect the asset prices in a way that helps insurance. Okay, and that's more similar to the kind of externality, for instance, you have in your paper with Yuli Sannikov. But yeah, so we do think that's an important other channel. Here we're more in the macro stabilization mindset and focused on the aggregate demand externalities. Okay, so putting some notation to this, the 3 periods are 0, 1, 2. And just to simplify, we're only going to imagine there's a high or low state for the risky asset. So just to simplify, there's 2 states of the world. And we don't know those states of the world until the last period. That's when it gets realized. In the last period, that state of the world is realized, and the dividend you get will either be the high dividend or the low dividend. Okay? All right. And there's these 2 types of agents, the savers and the borrowers, and the fraction of agents of each type are given by fee. Okay? So if you want to simplify, I think fee is 1/2, 1/2. Half the population is saver, half is borrower. Yeah. All right. So now I'll just spell out technology and preferences here. So in period 0, 1, we are engaging in production. So output is coming from labor. All right. And here I've assumed that the only work is done by the savers. Okay. That is just one case. We treated all, we also allowed for both borrowers and savers to work, right? But I should mention here, what is the interpretation of this borrower and saver? there are a couple of interpretations. So one interpretation is the borrowers might be homeowners who are borrowing to invest in housing, which is the risky asset. All right. In that case, maybe it would be natural to allow both types of agents to be working. But another application we had in mind, closer to, in spirit to these finance papers I mentioned, is that the borrowers are banks that are leveraging to invest in risky assets. And in that case, it was a little unnatural to imagine labor there. So we are looking at now the version where all the labor is done by the savers, okay? But it doesn't affect the results. So that's what's output produced in the period 0 1. And this is just saying that output has to equal aggregate consumption, which is just the weighted sum of consumption of each group. In the last period, period 2, aggregate consumption depends on the state of the world. So we're indexing by omega, and it has to be less than or equal to output, but output is now just the dividend from the tree. Okay, it's an endowment. This is just to simplify. We could clearly add labor in the last period. All right. Preferences are the simplest you can imagine. There's just log utility, and they are really the same between borrowers and savers, except for the fact that, you know, borrowers might be, I think I have this switched up. I'm sorry. So this should be, yeah, this is switched up. This is savers, and this is borrowers. I thought I had fixed this, but I didn't. And so savers, they work. So you have this utility of labor in addition to the preference over consumption. But in terms of preference over consumption, they have the same preferences, log utility. Now, this is just reiterating what I said. On top of this, we're going to have a market arrangement that involves nominal wage rigidities and a zero lower bound binding at t equals 1. Okay. And we're going to assume that at t equals 0, it's not binding. Okay. So that we can ask the question, what should monetary policy do during the boom? Okay. This is the budget constraints that agents face. So on the top here, I have savers. Let's look at that first. So savers are consuming and saving for tomorrow from their current wealth, and their current wealth is coming from their assets and their labor income, and maybe potentially transfers from the government. And tomorrow they'll consume also from their wealth and labor income, and they'll also save for the last period, for period t equals 2. And in period t equals 2, their consumption is just going to equal what they saved. Okay. So that's basically does it for savers. Very simple. All they're doing is saving in a riskless asset. On the side here, I'm emphasizing that their labor is not really going to be a choice because of sticky nominal wages. We're going to imagine it's the demand side that's determining, it's firms that are determining how much they get to work, dependent on the output demanded in those periods. So we're going to take from their point of view these things as given. All right. Turning to borrowers, much of it is the same, except we don't have labor. And the only new thing is we also have the risky asset. So we have the same riskless assets as before, but we also have the holdings of the risky asset. Okay. So initially they own the risky asset. So since the fraction of agents in the economy that own this asset is phi b, this is the quantity they own. Okay. Each one of them, 1 over phi b. But they could sell it if they want to or buy it. So this is how much they buy, X1B. So X1B is the holding of the risky asset. And the same is true between periods 0 and 1, and the same is true between periods 1 and 2. They're choosing how much to hold of this risky asset. Okay.
You cannot go short. That's what the inequality means.
No, the inequality is just the budget constraint. We're allowing them in principle to go short, but lo and behold, here, this is a representative investor, and they have to hold the asset in equilibrium. So there will be no short position in equilibrium. So in equilibrium, x1 is going to equal this number here, and this term is going to be 0. This term is going to be 0. Okay, that simplifies the model. We could have trading among investors or allow savers to be able to save a little bit in the risky asset. And that would change things a little bit along these lines. This is the simplest version. Okay, there's one more thing I want to emphasize that's different, which is we are introducing this tax here, or subsidy on borrowing. Okay, and that's the macroprudential tax or subsidy. Okay, so that's, we could do it with a quantity constraint. So when you actually go out and think of regulation, you're probably not going to do it with a tax. But as usual, for thinking about how big these distortions are, it's useful to think of a quote unquote shadow tax. And that's what we're doing here. Okay.
Just to make clear, there's no macroprudential policy at time 1. No? It's all at time 0.
Yes, it's all at time 0.
And
because
monetary policy is essentially also at time 0 only because at time 1 it's bounded by the 0 lower bound. Is this correct? Or?
Exactly. Right. Perfect. Okay, so yes, exactly. All right, so the other thing I wanted to tie in, and in line with the introduction, we want to have a measure of how bad things are doing on Main Street. So in the context of our model, that's captured, one way to capture that that's popular in macro is to think of output gaps, okay? And a related concept that actually is 1 for 1 here is this notion of a wedge. So if you calculate the marginal rate of substitution between consumption and labor, compare it to the marginal rate of transformation, which here is just 1 for 1, you get a sense of how distorted the economy is. So in a recession, labor and consumption are going to be too low relative to the efficient level, and that's going to look like a positive labor wedge. Okay, it's going to look as if we were creating this recession by taxing labor a lot. Okay, in a neoclassical setting, we're not in a neoclassical setting, so it's not happening because we're taxing labor, but it looks as you know, you can measure it in that way. That's a metric for how deep this recession is. So it's popular. It's called labor wedge. And we're going to represent our result. It's useful to have this because our results are going to be linking the macroprudential policies and monetary policy to what those labor wedges are. Okay, they play the role of sufficient statistics. All right. Okay, and this is what we call macroeconomic stability. What I mean by that is we call macroeconomic stability the idea that we would try and make in time 0 the labor wedge 0. Okay, because you're in a boom. There's no bound on monetary policy. So why would you have a recession, or why would you have, you know, why would you overheat the economy? So mu equals 0 is actually the optimum if you were not considering anything going forward. And that goal, we're going to, you know, label macroeconomic stability at time 0. All right. Now, the important thing is whatever happened at time 0, the debtors went into debt and the savers saved, and that quantity, which is equal in equilibrium, is going to impact what happens in period 1 and 2 in the continuation. So how much debt was taken? Yeah.
Stability is a level measure in your model. It's not the volatility. Many people would think of stability as a volatility measure, but here it's just an output gap measure.
Yes. Great question. Let me go back to this. We are, this is somewhat, this is a trick. We're going to assume everything is deterministic here. Okay. So we know a recession is coming, and it's impacted by how big, by these financial decisions. That is just a modeling device to simplify. We could add that there's a risk of a recession coming, and we've done that. And, you know, maybe it's coming with some probability, or the size and severity of the shocks are variable. And that would introduce uncertainty. And all it does is complicate the analysis, because at the heart of it, it's always this trade-off between, you know, things are good here, but things might get bad. And we're going to be trading those off. And the easiest way to think about that trade-off is to abstract from uncertainty. But we've done it with uncertainty, and you get the same ideas. But yeah, so we're kind of playing this game, which is useful to simplify, which is to think deterministically. But I'm thinking of stability in that sense because we're still going, 0 would be stable in the sense of being the efficient stable allocation. Okay, and in a world with shocks, departing from that efficient level, if that efficient level were unchanged with respect to the shocks, would translate into volatility. But yeah, this is a common theme, that we don't just care about volatility, we care about departures really from the optimal allocation. And the optimal allocation may itself be volatile. So we're focusing on that departure. But it does translate to volatility in extensions of the model. Okay, great. But there is risk here, and risk is very important. So I sort of misspoke. There's no uncertainty is in terms of the fact that we're headed to this recession, but there's uncertainty in this asset, and that's what's creating this leverage incentive at time zero, okay, for the investor, and that's what's going to be affecting in this period asset prices and the real economy. Okay, so it's very important to have risk. We do have risk in terms of the asset, but we're abstracting from the other sources, the macroeconomic risk, right? Because this is risk, but it's not realized until time 2. So what we don't have is any realization of shocks in time 0 and 1 that's risky.
I forgot the redistribution. Can the government redistribute at time 2? Would this make a difference?
No, we don't have any redistribution here. So that speaks to we're going to stick to incomplete markets and not allow any tools to completely undo that. So if you had perfect redistribution here, you could achieve risk sharing, right? Yes. So all our results would go through if you have some risk sharing, as long as the government's not able to do that perfectly. Great. Okay, so we're ready to get something out of this. Okay, so we set it up and now come some results. So I was saying that the debt that was taken in period 0, which is B1, it's labeled B1, but it was taken up in period 0, is a state variable for how things are going to unfold in periods 1 and 2. And it's a sufficient state variable because in period 1, monetary policy is constrained. So everything is just going to be a function of this level of debt, okay? And an important result, which we expand on more in the paper, how, deriving it, etc., but it's very intuitive. I'll give you 2 intuitions, is the following, that the level of debt is going to negatively affect the asset price at time 1. And in this economy, there's a 1-to-1 relationship between that asset price and output. So it's going to affect, the more indebted agents are, the lower is the asset price, all things the same here, in period 1. Period 1 is the recession period. So think of it, the higher debt, the lower housing prices, for example, okay? Or the higher leverage, the lower stock prices. And that is going to create a drag on the economy on Main Street here, okay? So output, Y1, is also going to be a decreasing function of debt, okay? Because of this link, okay? So why are these things linked and why negatively related to debt? Here are 2 intuitions. But first, I would say we call this financial fragility, the idea that you would think about the amount of debt as affecting asset prices tomorrow negatively, and thus output, okay? So that's the concern at time 0 of those financial decisions. So higher debt here intuitively is, if the investors come in with higher debt, they will have a lower risk-taking capacity for investing in the risky asset coming into the next period. So their demand for the risky asset will be lower, or what's the same, to hold the same amount, which is what will happen in equilibrium, they demand a higher risk premium because they're indebted to a larger extent. So the risk of the asset looms larger to them because they're closer, to they have more liabilities that are not adjusted by the realization. So that's going to demand a higher risk premium, which, given the dividends fixed in the future, implies a lower asset price. And that lower asset price is going to impact in terms of lower consumption. An alternative intuition, which is equally valid, is that higher debt, you can see it through the risk. This is like thinking about the Euler equation of the risky asset. You can also think things through just thinking about the Euler equation for the risk-free asset. Okay, and here higher debt means that there's a higher precautionary motive, that you're in so much debt that going forward the the natural interest rate, so to speak, is lower because of the precautionary motive. And that's going to lower consumption if you cannot lower the interest rate. So this lower consumption is because we have the zero lower bound here. So the interest rate you would need for consumption not to fall is lower, okay? But you're constrained.
Is the zero lower bound works that way, but it could also, can you wipe out some of this debt by inflating it away? That's also got a zero lower bound and the wage fragility.
Yeah. The zero lower bound is going to make that difficult also, because if anything, you might have forces for deflation here. But you could do debt forgiveness or try and create inflation in future that affects this debt if it's long term. And that would be another kind of insurance device, if you like, that we're abstracting from. Okay, but risk is always key here. Otherwise, there would be none of this effect. Okay, our model technically has Gorman aggregation. We have the same preferences log. So if people are indebted with each other, that's not making the natural interest rate change, except for the fact that we have incomplete markets and risk. All right, so that what breaks Gorman aggregation, what makes distribution matter is the risk. Okay. All right, let's get to some goodies, some results. Okay, so we said the allocation is pinned down by debt. Okay, that means we can compute also the utility for the borrowers and for the savers as a function of debt. So I'm calling that V, the value function. And the key result can be obtained. I'm not going to show you the whole planning problem, everything. Let's cut to the chase. The key results can be obtained by thinking of the marginal rate of substitution that agents would compute compared to the one a planner would compute. And the difference is the planner is going to internalize externalities, whereas private agents are not going to internalize externalities. Okay, so that's what I've done here. Basically, if you see lambdas are these Pareto weights. They're not going to play an important role. But the key thing is the marginal rate of substitution is the ratio of these derivatives of the value function, because they capture how much happier you would be if debt were higher, in which case utility of one agent would go up, the utility of the other would fall. Okay, and that's related to the ratio of marginal utilities, which with log is just the ratio of consumptions. Okay, and that's the private marginal rate of substitution. But this is the departure from it and there is a departure if this term is non-zero. Okay, and this term is very simple. Mu1 remembers the labor wedge. So this is saying in particular that if there's no recession and no boom in period 1, then this would be 0, and then we would get an equality here. So in which case the planner's marginal rate of substitution is the same as the market's. There's no externality. Okay. The reason there's a departure is if mu is not 0, so that there's a labor wedge, there's an output gap in period 1. In that case, we care about that because that is going to affect output there. And since there was a wedge, we may want to increase output, for example, if there was a positive labor wedge. So in that case, there's a externality here of a given sign. All right. So the bottom line, this is just reading an equation to bring it to life. The bottom line is this implies that, this is a measure of the externality. All right. And so now I'm going to give you 2 quick results in succession, which is
coming back to this dy dB. You would say the higher the risk is at time 2, the bigger the externality. Follows this directly from this equation?
Yes, that would be true. I'm not emphasizing that, but the higher the risk, because with 0 risk, this term is 0.
Yes.
Yeah. So that kind of relationship would hold here. Yeah. Absolutely. So just to simplify this equation a little further, we're gonna choose the Pareto weights so that we don't have any redistributive concerns here. Okay. So that's accomplished by choosing lambda this way. That way we can focus purely on this externality, right? We have the general case in the paper, but doing so implies that when you just have monetary policy, so here's our first result, the first box in that table I mentioned. If you only have if the only thing that's available is monetary policy and expectations are rational, then monetary policy should lean against the wind, should make mu0 non-zero. You should have a labor wedge in the first period. If there's a labor wedge in the second period, which there is, okay, we're going to be thinking about that case where the zero lower bound is binding, so there is a labor wedge there. And you'll recognize this was the term I had earlier, this externality, okay? So that's why that was important, okay? And if this term is non-zero, okay? Now this term, you know, is governed by this numerator, which I've expressed here. There's a little bit of algebra, but the key thing I want to point out is, although this can be non-zero, there's a benchmark case where debt, initial debt, so it's sort of an Adam-Eve story, initial debt from borrowers was zero. So we're thinking of all debt as being newly contracted. In that case, this term is zero. And we think of that as kind of a benchmark, right? In general, though, this term would be non-zero, and you get some subtle effects for leaning against the wind, okay? We also did this with log utility, and that's affecting the result. If you depart from log utility, you could also get that you want to lean against the wind, or you want to, in fact, create a recession, you know, create a boom in period zero. So the bottom line I'm trying to say is mu0 can be non-zero, but it can take on both signs. It depends on this initial debt. And in a benchmark, at least stylized case, where initial debt is zero and you're just focusing on new debt, the term is zero, okay? So we're going to summarize that a little bit as cavalierly as saying, okay, you might want departures from setting a zero output gap, which we call, you know, with some abuse, inflation targeting, in the sense that it's the standard prescription for monetary policy. Get a zero gap in period zero from monetary policy. You might want to depart from that, but it depends, and it's somewhat subtle, okay? So in that sense, we're going to fill this in here with, you know, here you get inflation targeting, but there's some, you know, asterisk if you want.
Okay, can I ask you something? Let's suppose I have two economies, one with a higher inflation target than the other one, and another comparison between R star, higher and lower. How would this show up in your formulas? Would it be in the muse or?
Say that again.
So I have two comparison. One is the inflation target is, instead of 2%, it's 4%.
Right.
When I go into the whole model is written at 4%. Or is another comparison would be, you have two economies with different R stars because the time reference rate is different of the.
Yeah. Here, remember, we don't have inflation, but I think the spirit of your question is, in one economy, in the next period, the zero lower bound is gonna do more damage. Okay.
Yes. And that would be the mu1.
Right, and that would affect the mu1, and then through mu1 affect mu0. Absolutely. That's the right way to think about this. All right, so although it might be non-zero, it could be on both sides of zero. In a simple benchmark case is that it is zero. Let me emphasize how maybe surprising this result is, because I think most people think, okay, no, it should always go in one direction, because if you want to lower borrowing, just raise the interest rate. That will, like, you know, lower borrowing in the credit market. So there's something subtle here, which is that does lower, in this economy, that does lower the amount of borrowing, okay, if you raise the interest rate. But the thing that really matters is the amount due tomorrow. So you're raising, in this log case, what happens is it's exactly balanced. You're going to borrow a little less in equilibrium, but the net payment that's due tomorrow is the same, okay? So this kind of shows that our natural intuitions that raising the interest rate will make us less vulnerable tomorrow are misplaced. At least as form of example, it can go the other way, right? All right, so that's what's key here, right? Now the rest of the results are going to fall out very, very quickly. Let me show you. So now suppose we have monetary policy and macroprudential policy. Then what the optimum is going to be, always target zero at time zero with monetary policy. So we would say that's, you know, perfect inflation targeting, regardless of those other conditions I mentioned before. So this is maybe a stronger version of inflation targeting being optimal. When you have macroprudential policy, you definitely want to let monetary policy do its usual goals. All right. And that's kind of this assignment of targets to instruments here. And macroprudential policy is going to take up the job of restricting borrowing, restricting this leverage. And in terms of the shadow tax that involves, that tau zero I mentioned earlier, it's 1-for-1 given by that expression that I said was the externality, right? So we can see that in particular, if we have a recession in period 1 because of the zero lower bound, then we want to tax borrowing. Okay, so that's how it goes. All right. And if instead we didn't have any recession tomorrow or any concern, we wouldn't fiddle with financial markets. So this is kind of a second best. You know, if since you will have distortions tomorrow, you don't like to mess with financial markets. They are producing a more efficient financial outcome, but by tinkering with them in this way with macroprudential policy, you can improve what happens in the real economy.
There are a lot of questions about margin requirements and all that. That would all fall under this category. How you implement this macroprudential rules could be margin requirements, could be a tax or anything.
Absolutely, absolutely. So in practice, I think the world is such that it's mostly quantity restrictions, which can be adapted to, you know, scaled up. So that's where they become either margin requirements or loan to value ratios. And we're just expressing what the shadow tax would be. In the model, you can also implement it with a tax, okay? And maybe in the real world, we'll think about taxes on transactions like this. Certainly, Tobin thought about that. But yeah, here you could, everything we're saying here has a parallel to the quantity regulations that you would think about.
But here, the tax revenue you pay back to the citizens.
Yes, yes, yes. That's why it's the same as a quantity restriction.
Yes.
Yeah. Okay, so I filled these two out. And now comes the time of delivering on this extrapolative expectation, okay? So here's how we're going to do it. We're going to assume that the investor, when it's investing in the risky asset, it faces this dividend risk in the last period if it decides to hold it, and it will in equilibrium. But between 0 and 1, the way it's thinking about this investment, you can look at the Euler equation between 0 and 1. It was looking at a rate of return on this asset, all right? A rate of return on this asset. And we're going to choose extrapolative expectations by assuming that that return that they expect, that these investors expect, is related to the past return, okay? So row 0 is what we did before. In the case of row 0, what they expect is actually what happens. And if row is non-zero, we're departing from rational expectations in the direction of extrapolative expectations, right? Now we're gonna think about this equation holding, but there's a couple of ways in the background to make it hold, to make this the case. And we do it two ways. I'm gonna spare you the details of that, but basically there's different ways of achieving that this is happening. And we played around with both ways and got the same result. So it's interesting for those can check out the paper. But basically, this is going to give you the intuition of what's going on. All right. So let's get to that. So previously, I showed you the marginal rate of substitution of the. So everything is the same now, except we have the extrapolative expectations, right? So the key thing is the following: when I compute the marginal rate of substitution of the planner compared to the marginal rate of substitution of the agents, which is this, I get the same externality I had before. Now I also get an extra effect, okay, which has to do with the borrowers are overestimating what they think their consumption is going to be tomorrow, okay? They might be overestimating, you know, in the case where they're overestimating this effect, which is the natural case, this effect is going in the same direction as this one, okay, right? All right, so there's something new there, but it's not changing the picture. Okay, what I want to emphasize is something else. If I just have monetary policy now, so I'm going to fill the lower left box of that table. If I just have monetary policy, this is what you want to do with monetary policy. You want to target a labor wedge or output gap that's equal to this formula. Okay, now the formula looks big, but there's a lot of things you'll recognize from before. Again, this is the externality. This is the new externality. Okay. So the fact that this is not 1 is potentially leading me to want to lean against the wind. Okay, but it's still up to this term being non-zero, just like before, right? And this term not being non-zero, just like before, really depends on this expression here, which I've given you here an expression for, okay? And you don't have to look at all the terms. All I want to emphasize is before I emphasized this term in the numerator, which could be 0 or change signs, but now we get an extra term, okay? And this extra term has a lot of intuition, and it's basically coming from the extrapolative expectations, right? So this extra term is the fact that if you, let's say in the boom period, lowered interest rates and created a boom, that would lead the asset price to go up today, which would, through our extrapolative expectations, increase this. That would increase the beliefs agents have about this asset, which would lead them to lever up more in equilibrium, okay? So the intuition is very straightforward, that what you're doing with monetary policy at time 0 is affecting the asset price at time 0, which is affecting these predispositions to borrow and to lever up, okay? So that's the intuition. In reverse, if you take the punch bowl away when the party is still going, you do contractionary monetary policy, that's going to cool down the economy, which is going to lower the asset price and cool down through this, lower the amount of extrapolation. By lowering the extrapolation, you're going to cool down borrowing, which means that tomorrow, when we're in that bust, we will have less leverage and the economy will not be in such a bad state. And because of that, you do want to do this, okay? And you see how the extrapolative expectation is important for this new intuition, okay? So that's what we got here, okay? So then I think what I'm trying to say is, if you only have monetary policy, the intuitions people have that you want to maybe lean against the wind are a little more subtle than people think, okay? But if we do think about these forces that I think we should be thinking about, extrapolative expectations that have been documented, etc., it provides a much stronger reason for leaning against the wind, okay, for monetary policy.
A quick question about, so the leaning against the wind is not affecting the extrapolation itself now in your model. It's not because we're leaning against it, the price increase will be less, and hence I expect less price increase in subsequent period. That's not what's going on.
No, that is what's going on. That is exactly what's going on. Because when you lean against the wind, you lower output.
I see. Fair enough. Yes.
Yeah, you agree? So you lower output,
it's -1 to 0.
You lower consumption and you lower the asset price.
Yes.
Gotcha.
Okay.
All right. So you had the right intuition. It wasn't more subtle than that, but I think it's important. I think it's important that it's simple and clear, and I think that's why the model is quite simple here, so that we can see through it. All right. So the final box here comes really quick, and basically, maybe some of the people who took the poll will be disappointed, but what we find is, again, if you have monetary policy in this simple setting, even though there's extrapolative expectations, you want monetary policy to focus on its usual goals, on its macroeconomic stabilization, not its financial stabilization. The reason is, with macroprudential policy assumed to be perfect as we assume it is, able to fill all the cracks, you can take care of the debt with the macroprudential policy. So it's so simple, there's nothing else to be said. It's just that simple. All the externalities here are coming from debt. So since you have a tool to deal with that, once you're dealing with that optimally, there's no reason to distort monetary policy. There's no reason to play third best with monetary policy. So there really is an assignment still of instruments to goals. So we recover this. Now there's two reasons to take that with a grain of salt. One is what I said earlier. I agree with, to some extent, that we live somewhere in between these two columns, okay? So then I would say you want to take a weighted average of these two boxes maybe, okay? And, future work would require to think about what the right average is. But then that means, here we would be averaging inflation targeting to inflation targeting, getting inflation targeting. But once you have extrapolative expectations, if you're averaging this with this, the conclusion will be that we should lean against the wind. So perhaps that lends support to the majority of those taking that poll that said we should do both. Okay, so you could do both if you think you're in a mixture of these two worlds. All right. But I have a final result which adds some subtlety also to this result. So even if macroprudential policy is perfect, up to now I kind of cheated. I created extrapolative expectations only during the boom. This might make sense if you read Minsky, because that's the emphasis is on the different phases of the boom. Okay, but if you read the financial evidence on extrapolative, it's kind of symmetric. Like people are also in a bust, they get really pessimistic overly. And with that perspective, then bringing that in, so we bring that in, we say, okay, now let's add extrapolative expectations during the bust. All right. So before I was assuming that rationality kicked in at time 1, and we only had the extrapolation business at time 0. And the Minsky moment produced perfect rationality. But now let's instead assume that during the bust, we are extrapolative. Okay. So here's just conceptually, I'm not going to do any math here. Conceptually, the key thing is before we had one state variable, which was leverage. And then we could solve everything at time 1 and 2. Now, beliefs are also a state variable. Because beliefs are not rational, what happened with the price at time 0 is going to affect the rate of return people see between period time 1 and time 0. And that's going to in turn affect the economy, okay, because of the extrapolation. So basically beliefs are a state variable that are affected by past asset prices. So in a nutshell, let me say more intuitively, if during boom times I cool down the economy, then when the bust comes, for any given price I obtain during the bust, people will have perceived less of a drop. And because they perceive less of a drop, they don't freak out as much and they don't have as negative pessimistic expectations going forward. All right. So in other words, if I don't make the price go up too much at time 0, the drop between 0 and 1 will be smaller, and that will help the economy at time 1 because it will reduce the amount of, extrapolative selling and drops in the asset price at time 1, which reduce the economic activity in time 1. Okay. So that's an interesting thing because with monetary policy alone, it adds a reason to lean against the wind. But this reason now doesn't disappear with just macroprudential policy anymore. Okay. And the reason is you no longer have that tight connection between targets and instruments because now you do have two state variables. So although macroprudential policy can handle this one, there's still in general reason to think about this other one, okay, and trade it off. And so that is, an interesting result we want to explore more. But basically, I'm doing that by adding a little caveat here to that corner of the box. All right. Okay, so that's all I wanted to talk about today and conclude here. Just saying we had this general theory, but we wanted to add extrapolative expectations for the, because it's been documented and ties in, I think, with the ideas in Minsky. And we see that there's a role for intervening to manage expectations. And, in some cases, macroprudential policy can take over and leave monetary policy doing with its usual conventional objectives. But I've given some reasons why we would want monetary policy to lean against the wind. Thank you.
Thanks a lot, Ivan. It was fantastic and very clear. Let me just throw a few questions at you. We ran very much over time today, but that's fine.
I'd love to get the questions in the chat box later.
Yes. So Marco Del Negro would like to know, doesn't the regulator needs to know the rho parameter? Is this realistic, or how would you recommend? I thought rho was the...
Yeah, I'm going back. So the other people there, yes, absolutely. Thanks, Marco, for the question. As usual, to do the welfare analysis, we're assuming the policymaker knows all. If you don't know all and you don't know rho, well, you're going to have to take an average over the different policy prescriptions and do the best you can with the information. But it is an important, obviously, input into the policy optimization and analysis. Okay, my reading is, it's not been too long that it's become a little bit acceptable to think about extrapolative expectations and estimate them, and we can make progress estimating that kind of parameter. But definitely, we've taken it as, in our analysis, as something that's known, and if it's not known, it adds a layer of difficulties. But it doesn't mean, I think, you would probably operate on some kind of average. It doesn't mean you don't want to do anything.
So the other thing is, I was wondering, you have extrapolation on the level of the price level, but you could also have extrapolation on the volatility of the price level, in a sense that once there's a huge price swing, people get very scared and project forward. I'm going a little beyond your model, that things are way more risky than they actually are, and that makes the downturn even more dramatic. Can you speculate along these lines a little bit? Or of course, it goes way beyond the model, but
I need to think about that. I think that's interesting, but I think it might be against the evidence, at least the way it's portrayed by Greenwood and Schleifer, because they show that these expected returns are positively related to the price dividend ratio in the market. So if prices went up, they don't suddenly get very worried about volatility. That would lead to
I had more in mind in downturns. You have a crash, and then people get very scared, essentially, and get out even more, and it
absolutely. But the question is, if that I have. The question is whether you think it's symmetric. Like, even a price rise makes you scared now because you think it's very volatile or something. But that's worth thinking about. We haven't thought about those second moments, basically.
So let's conclude. I mean, we're running already 20 minutes over. But it was fantastic. Thanks a lot. But we always end with a positive note. So you have to give us a positive perspective. What are the positive conclusions from this paper?
You didn't warn me about that. Minsky is full of negativity. No, I think on a positive note, let me just say two, I guess. One is a little, I think in macro, there's been a lot of work. Ours is an example only of including financial imperfections and how that interacts with the economy, and then thinking through the policy. And so on a research front, I'm excited about that area in general. Positive note for the whole literature. And, the positive message in, let's say, even Minsky, is that we need to understand these negative feedback effects, this instability, so that we can make policy better. So there is a positive hope there, that, largely we have very good tools for stability, but almost, except for the financial part, is crucial, and we have to make more progress on thinking about. It's a hard, kind of thorny issue, macroprudential policy, but we have to make more progress on it, I think, and I think we are.
Cool. Yeah, that's definitely a big contribution to the field, and let's push it forward. And thanks a lot, Ivan. Hope to see you soon, and thanks for everybody for participating, and see you next week.
Thank you.
Bye-bye. Thanks, Ivan.
I'm happy to get email questions.
Send emails to Ivan with all good questions.
Great.
Thank you. Bye-bye.